Hi, this is Alessio. Hope you're well. It's been quite a while since I made a video update on the major stock market, so I want to dig into the chart here of the S&P and explain, now that the market has reached all-time highs after the capitulation levels we mentioned to you back in April, what could this mean for the major markets? Are there any risks around the corner? I will also explain to you the significance of this chart you're seeing here, what this means, plus also this diagram you're seeing here. Plus also we'll dig into the fact that we're seeing extreme greed now in the major stock markets, what this potentially means for the market here as well. So let's dig into the chart. All right, guys, join me. All right, guys, welcome back. So very interesting development here on the major markets. So in just a few minutes, I'm going to dig in some important charts for you, and especially this particular chart you're seeing here, as well as I mentioned before, the sentiment readings and this particular chart you're seeing here. Now, before we begin, I think it's important to just set the context. As you may recall, after the markets crashed here, a crash, by the way, which we anticipated and we saw coming, we then reached capitulation. So you may recall in my video back in early April, I mentioned at the time that this was a capitulation event. In other words, the market was very likely reaching a bottom, and that I was expecting a rally back. And I mentioned those levels to you at the time. In fact, in the member videos, I mentioned quite likely the market could bounce back to a region between 5,600 to 5,800. Here's a few short clips. We'll come back. For the first time after many years, since 2020, we have an oversold condition on the weekly chart of the S&P. In fact, this has not occurred since the year 2020. This particular extreme oversold condition also supports the view that we're reaching capitulation. In other words, this particular chart also increases the probability that we're reaching capitulation, or indeed that we have capitulated here on the S&P. So the bottom line is the odds are increasing. So this chart seems to indicate the odds and the probability is increasing for some kind of a strong bounce and rally in the stock market and a likely bottom in the market. In fact, I think it's quite probable that we could see a strong bounce back up into this region between 5,400 to 5,600 and potentially even higher, maybe even up to the 5,800, 5,700 levels as well. So the odds are increasing for a strong bounce back up to those levels. The fear and greed index, as per this data, dropped to 4, and what that shows is that the stock market, the S&P, just fell to a region of capitulation here, below the minus 4.25 region there. There was also what's called a breadth thrust signal. According to data and some studies, after such breadth thrust signals, the market, in other words, the major stock markets like the S&P, tend to rally, or in other words, tend to go up and show positive returns, typically by about 10 to 15% going forward. So in other words, guys, when something like this occurs, typically these breadth thrust signals end bear markets. So in other words, guys, this breadth thrust signal, as we can see here on this chart, is a very bullish indication for the major stock markets, indicating that we could see higher levels in the next several months. We could potentially see a continuation of the rally in the next several weeks and months. All right, guys, thank you very much for watching that. So as you saw, after the markets reached capitulation here back in April, if at this point, if back in early April, you told anybody that the stock market was getting ready for a major bounce and rally, even potentially to new all-time highs, nobody would have believed you. And the reason is that most people at the time were paying attention to the news. As you may recall, I said ignore the news. But of course, many people were focused on the Trump tariffs. Everybody was blaming the crash on the Trump tariffs. So nobody at this point, probably only a few people, believed at this point that the market was going to bounce back and indeed form a bottom. Okay, now I should say, guys, I'm not trying to say to you that I got everything right. No, I did not get everything right. So for example, over here, some weeks ago, back in late May, I would say beginning of June, I was expecting a pullback to start here. Okay, but of course, that's not what happened. Having said that, though, even though I was expecting a pullback to start some weeks ago, nevertheless, I did warn that the S&P had to break down first below 5,800 before the odds increase of a pullback or some downside risk. Here's a clip. Watch this level carefully, the support level 5,800. So that's support. If the S&P was to fall below the lows of today, 5,800, that actually would increase downside risk, potentially to fill some gaps. Okay, guys, so my point really at this point is that even though we were expecting a bounce back from the capitulation lows of April, nevertheless, this rally has been much more unusual and untypical than the ones we usually see. And for example, let me just show this to you. If you compare this rally to the one that occurred back in the COVID pandemic year of 2020, so after the major crash, again, the COVID crash of the year 2020, as we can see here, notice that the subsequent rally, the rally that followed, was actually more like the ones we usually see. For example, look at how many pullbacks we got here. We got many pullbacks that was more than 5%. This was 7%. This was 6%. This was 8%. And then after reaching new highs, then we had a 10% drop. But you will notice from the capitulation lows of March 2020 to the new highs that it made there were several pullbacks of more than 5%. But if you compare it with the most recent crash that occurred this year, you'll see only one of these pullbacks, one of these drops was more than 5%. This one here was very shallow, too shallow to count as a proper pullback, the ones we usually see. Okay, so that's why I was expecting at least some kind of a 3 to 5% pullback, which as it happens, the market has not given us as yet. And also the speed of this rally is very unusual. I mean, I was expecting the market, for example, to make new highs later this year, perhaps by September or October, but as we can see, the market made new highs just within a matter of 2 months. I mean, that is incredibly quick. Now, I'm sure the question is in your mind right now is, okay, now that we've made new highs, now that the market has taken out the prior highs of February, are there any potential risks around the corner? Or is this market just going to continue going higher without any kind of pullback or correction? Well, first of all, let me show you this. Some important data from the CNN Fear and Greed Index. Now, even though the CNN Fear and Greed Index still remains in that greed territory, but there are some signs of extreme greed. For example, based on stock price strength, we can see, for example, this is an extreme greed territory. If we go a bit lower, and let me show you this, based on stock price breadth, the most recent reading again shows extreme greed here as well. And very importantly, if we look at the put-call ratio, the put-call ratio also happens to be in extreme greed territory. So there are indications, very strong indications indeed, that we're reaching a point of extremely optimistic, over bullish, greedy sentiment, which usually occurs right before a market reversal or indeed some kind of a downturn. Now, before we discuss this pattern we're seeing here on this chart, I want to also show you this, some other important data. This is the sigma chart. Now, sigma is a measure of standard deviation, and we can see that both the S&P on the left and the Dow on the right are reaching levels of extreme overstretched, overbought, overextended conditions as shown to us by the sigma. Again, the S&P is not far away. In fact, it's extremely close to its red extreme sigma level here on the weekly chart. The Dow is also very close and just about penetrating that red extreme sigma level there on the weekly chart, which shows that the markets, both markets here, both the S&P and the Dow, are extremely overstretched, overextended, and the risks are increasing for some kind of a major pullback or correction. And that is not all. If we take a look at the S&P futures chart, the S&P September futures, this is the 2-hour time frame, you will notice that there are several negative divergences. So here, for example, the S&P makes new highs. Okay, so we make higher high and another high here, but look at the MACD. The MACD makes lower highs. Okay, so there's a lot of indications of weakness. So usually when we get negative divergences after extremely overbought, overextended conditions, this is a warning sign that the market strength or the force of the uptrend is potentially weakening. And again, also increasing the risk of some kind of a potential pullback or correction. So going back to our daily chart. So yes, it is a good sign, a positive sign that the S&P has now made new highs. And I think it's an indication of strength in the market that potentially we could see a continuation of the uptrend or rally in the next several months, perhaps by the end of this year. However, that does not mean that there are no risks. There are risks, very strong potential risks in the market of some kind of a potential pullback or correction, likely in the next few weeks. And that is why I want to draw your attention to this diagonal pattern. Now, what I think is happening as far as the chart of the S&P is concerned is that we're seeing an ending diagonal pattern as shown to us by this, again, by this chart and the yellow lines I've drawn here on my chart. Now, these kinds of ending diagonal typically form in wave 5 or as C waves, usually at the end of the moves, okay? And by the way, when the market extends beyond the top line, so you can see here the market, the S&P, went above the upper trend line here. That's what's often called a throwover. But again, these patterns are very unstable, as you will see from this diagram. Let me just show it to you. So as mentioned, these patterns often occur towards the end of a rally. And again, they're highly unstable. And when these occur, we typically see divergences on the lower time frames or even on the daily chart. So as we see here, typically these patterns form when the market moves too far, too fast. Okay. And indeed, I think that the higher probability is, because these patterns are highly unstable, the high probability is that eventually these patterns resolve to the downside. So eventually the market becomes so exhausted, again, after the divergences and overbought, overextended conditions, that as you can see here, the market then eventually breaks down below both trend lines especially the lower trend line, and then drops lower. Again, a pretty sizable correction as we see here in this diagram. And by the way, that is what I think is going to happen to the S&P and the major markets in the next few weeks. So I think it's quite likely that in the coming weeks, we're going to see a breakdown below both of these trend lines. So at the moment, the S&P is above this upper trend line here, the top part of this upper yellow line, this diagonal formation. But I think very likely in the coming weeks, we're going to see a breakdown below this, again, this rising trend line and this lower trend line as well. I think both of these levels are going to break. And the first support levels I'm looking for to break are these, the green and the blue lines. So what we need to see to increase the odds of a local top or an intermediate top is to see a breakdown below 6,100, 6,080. So I'm going to watch these levels very carefully. If the market breaks down below 6,100 to 6,080, that would be the first initial sign that the market has likely reached an intermediate top. And indeed, that we're going to see a breakdown and indeed a correction or pullback. That has not yet happened, but I think it's becoming more likely. Again, as we just explained, there are divergences on the lower time frames. There are also signs the S&P and the Dow is becoming overstretched to the upside. And as I mentioned earlier, there are several indications of extreme greed here based on the put-call ratio and many other sentiment measurements. So going back to our chart of the ending diagonal, that I think is what's going to happen eventually in the coming weeks. So I'm looking for a breakdown below the lower trend line as well that I just showed of the ending diagonal formation, and indeed a sizable correction here once this diagonal formation completes. And again, I want to just remind, as yet, we do not yet have a confirmation that this ending diagonal formation has completed. We need to see a breakdown of support. Support has not yet broken. Okay, but I think that's what's going to happen in the next several weeks. All right, guys, thank you very much indeed. If this video has helped, please give it a like, and also please subscribe for future video updates. Thanks a lot. Bye for now.